Hi, this is Kim Butler. So I have a question for you. How do you help a younger person realize the value of using or utilizing, not easy words, of the death benefit while they're living? Do you have a way that you can show this to them? Todd,
Absolutely.
this has been
Absolutely.
this has been your deal for a long, long time. Give us a demo.
It is because it's an important piece. And I think a lot of people think of the death benefit as something that somebody else is going to get versus something that's actually going to benefit them. And so this plays that, I'll call it the selfish side. But I think it's important, especially on a younger person, they don't really see the value of leaving assets many times. And so that's the best time to put this in place. And yet it's the time when they don't see the value of it. And so it's our job, I think, to get that across in some way so that they do see the value in it. They want to put it together because just from years and years of experience with clients and seeing them make that crossover and what happens when a client gets into those later years, all of a sudden the legacy becomes an important piece, even though maybe it wasn't on their forefront of their mind when they were younger. So this is what we're going to look at here. And so one of the things that we have to think about up front, and it's easy for clients to get, it's harder for advisors to get many times, and it's the idea that is there a possibility that because we buy life insurance, that we could have as much in assets as somebody who didn't buy the life insurance and have that outside of the life insurance. So in other words, let's say that somebody had was committing, they bought into the buy term invest the different strategy of just having their assets and cheap term insurance, and somebody else understood the idea of having permanent life insurance. And the person having the permanent life insurance could have as much in assets outside of the life insurance, not including the life insurance, not including the cash value, totally separate, as much in assets as the person who went straight to the assets. And I say, yes, it's more than just a possibility. And it's part of what we talk about when we talk to our clients, right? The idea that since we have life insurance, we have the opportunity to take advantage of other opportunities that come along because we're in a position of cash. So we could use that life insurance as it's growing to buy assets outside of the life insurance and use the asset to pay back the life insurance and do that over and over again across the process so that we end up with the life insurance and the other assets. Because life insurance truly is an and asset, not an or asset like most other places we put money, right? All right, so let's look at that. So what we have on the left, this is our buy term invest the difference person, and they bought $2 million worth of assets. Kim's changing the title on that particular asset to just buy term invest the difference. We're going to have $2 million worth of assets. The term insurance now has gone away. They're earning, let's say, 5%. And now that this person has reached this point in time, they're stuck in a scenario because of the idea of you can't consume principal because you don't know how long you're going to live. They're stuck in a position of really the only option for making use of these dollars from an income standpoint is the interest. So they're in an interest only scenario. So what we'll do is we'll click on the interest only button and let's change our illustration period to 20 years. We're going to click on the interest only button. We see this level. Now, one of the things that is going to probably happen is this is not going to be the only asset. There's probably going to be some Social Security, maybe a little pension, and it's going to change the way these dollars are taxed because it's going to push these up in the tax bracket because the other assets are going to consume the lower end of the bracket. So let's just assume $50,000 in Social Security and other pension dollars on this couple. And so if we put that in there, then it pushes our taxes up to $18,895 per year on the $100,000 that we're earning each year on this account. Again, that's 5% on the $2 million. So if we're pulling $100,000, the interest earned off the account, paying $18,895 in tax, then our net spendable is $81,000. Now, first off, this is going to be an eye-opener for a lot of people. Most people think, man, if I just had $2 million, I'd be in great shape. They're going to be shocked to see that if they could earn 5% safely every single year, again, net of any management fees, that's going to only equate to about $81,000 a year of income. All right, so that's the scenario here. Now, are there things that could happen to this account that could change this? What if earnings rate were 3% instead of 5%? What's going to happen here is there's going to be a drastic decrease in the amount of money that can be spent, down to $49,000 a year. And it's because all of the dollars in this scenario have subjected this person to directly impacted by whatever the interest rates are. There's no way around it, because again, we can't consume principal. We don't know how long we're going to live. So this whole buy term invest the difference strategy that this person bought into at age 35 is now impacting where they are in the future, in this case at age 65. So today's decision has huge impact into the future of what can happen. And that's the part that people most of the time leave out is, okay, during the accumulation phase, we also have to be wary of what the distribution portion looks like. Because what's more important, net worth or cash flow? And the answer is cash flow, yet most people are just focused on the net worth, especially during the accumulation phase on the early end. We have to look at both sides. All right, so let's push that back to 5%, Kim. And let's look at a different option. So on the right-hand side, what we're going to look at is the idea of buying a permanent whole life insurance policy, ending up at age 65 with the life insurance policy plus $2 million worth of assets. If we have the $2 million worth of assets, now the death benefit doesn't fall off the books. Same 5% earnings rate, but there's a difference in the distribution strategy. Because this individual knows that $2 million is going to replace this asset at death, they have an option to say, you know what if rather than just interest only, what if we decided to consume this asset over 20 years? And so instead of just interest only, we're going to click on the pay down button. And what that shows us is that we could pull out $160,000 a year rather than just $100,000. But here's what's interesting. That level $160,000 a year actually causes a decreasing tax payment across that time frame. So while the first tax is the same as the person on the left of $18,895, the last year's tax is only $917. Well, if we're pulling out the same amount of money, but we're paying less and less tax, then what that creates is an increasing net spendable income column. Now, inflation is definitely a piece that we have to be wary of, and there's only one way to combat inflation, and that is to have more money. That's the only thing we can do. That is some people call it a stealth tax. It's something that's put on us. It's terribly invasive, but if we can earn more money, that's going to help offset it. The poor person on the left, while they start with $81,000, a lot less, it's actually reducing over that time frame due to the impact of inflation, whereas the person on the right has some inflation hedge in the fact that they've got an increasing income because of that decreasing tax. Now, what causes the decreasing tax? Well, the $160,000 a year is a combination of earnings and principal. The more principal we consume, the less principal there is to earn income, and we're only paying tax on the income portion. So as that amount of that ratio between principal and interest shifts over that time frame, it actually reduces the tax. So we end up with more money. Now, let's turn on the compare column, Kim, if you would. And that's going to show the difference between these two income streams. And what we see here is that the individual starts with $60,000 more because, again, the strategy that's afforded them, because the life insurance really gave them the permission to be able to do this strategy of pay down, knowing it's going to be there to replace this asset. And it grows to $78,000 across this time. So there's quite a bit of difference, and it means they were able to spend $1,378,000 more than the person on the left. All right. So when we look at this point, we see, well, that's all great, but the person on the right is out of money. it goes to zero across this time frame. But remember that death benefit that was purchased that didn't have to be canceled at age 65? We're able to offset it or whatever other strategy we want to do. That needs to be included in this scenario. So if we go to the PLI Inputs button, on the right-hand side, we can pull in that stored life insurance data. So this was our 35-year-old that we were talking to. So we're going to click on that age 35. And right here, it asks us, let's do that again.
Sorry, too quick.
We're going to pull in our age 35 life insurance illustration. But remember, the illustration that we're looking at is when this person is age 65. So we're talking to the 35-year-old about what today's strategy, rather than doing the buy term and invest the difference strategy that gets them stuck in the interest only scenario in the future, we've opened up the idea of being able to do a pay down because we took a different strategy today. So at age 65 is when we want those life insurance values to come in, because that's where we're illustrating what we can do during the distribution phase. When we do that, because we had this offset, we see that there's no premium payments, and we see that the death benefit has grown to 2.8 million, and we have a starting cash value of almost $1.5 million. So go ahead and close this so we can see what that looks like. So now what we see is the person on the right, because they did a strategy of buying life insurance and then using the assets along the way to help supplement to build assets outside of that life insurance asset, that they were able to spend $1,378,000 more. And if death did occur at age 84, they could pass $3.7 million rather than only $2 million, as would be the case on the person on the left, because the person on the left is now self-insured, right? And if we don't have life insurance, that's where we are. We're self-insured. And so the amount that gets passed is much smaller. And what does that mean for the person on the right? It means that, hey, in the likelihood that they're going to live longer than 20 years, right, based on our increasing mortality rates, that they're going to need an asset when that first asset runs out. Well, life insurance shines on the back end. So the longer we can hold the life insurance and then start spending those dollars out in the future, the better off we're going to be. And at Truth Training, we will talk about what happens to that individual on the right if we do live longer than that. How do we take that further out?
Okay. Awesome. I'll look forward to seeing you at our next Truth Training. It's a fun 3 days. Todd and I enjoy sharing the wisdom with other like-minded advisors, and we welcome you. Thanks much.